Hey guys, in this video we will be focusing on key budget components, dissecting the differences between monetary and fiscal policy, and exploring policy measures to tackle recessions, depressions, and periods of high inflation. Before we dive deeper into economic concepts, let's establish some fundamental principles. Revenue is the income generated by a business on a short-term, day-to-day basis. Capital represents the resources used for long-term investments, typically exceeding a year. Debt involves borrowing money with the obligation to repay it. Equity signifies ownership in a company. Consumption or spending is identified as the most crucial economic activity. Budget contains two important components: receipts, which represent the total amount of money received by the government, and expenditure, which refers to the total amount of money spent by the government. Receipts can further broken down to revenue receipts and capital receipts, revenue receipts to tax revenue receipts and non-tax revenue receipts, and capital receipts to debt and non-debt. Similarly, expenditure can be broken down to revenue expenditure, which are expenses incurred in the day-to-day running of the government, and capital expenditure, which are investments that create assets or reduce liabilities. Now let's see each of these components in detail. Let's explore direct taxes. These are taxes directly levied on individuals or entities. Examples include income tax, corporate tax. Next up, we have indirect taxes. Unlike direct taxes, these are not directly paid by the individuals or entities to the government, but are collected by intermediaries. Examples include GST and customs tax. Moving on, non-tax revenue also includes income from various other sources. This includes profits earned by public sector enterprises and dividends paid to the government by these entities. The government earns interest from lending money to individuals, businesses, or other governments. Money is collected from various fees, penalties, or fines imposed for regulatory violations or administrative purposes. Both external grants received from the international organizations or foreign governments, as well as internal grants provided by the central government to states, contribute to non-tax revenues. Let's explore debt capital receipts, which involve raising funds that create liabilities for the government, like funds raised by the government from the public. These include funds raised by the government through both internal and external borrowings. Non-debt capital receipts, these are funds obtained without creating any new liabilities for the government. This involves the recovery of loans and advances previously extended by the government. Another significant source of non-debt capital receipts is through disinvestment. Revenue expenditure encompasses various day-to-day expenses incurred by the government, including interest payments on loans, salaries, pensions, subsidies across sectors, defense expenditures, postal deficits, law and order expenses, social and general services expenditures, as well as grants allocated to states and foreign countries. Capital expenditure includes disbursing loans, repayment of loan capital, development spending, defense modernization, and improvements in services like railways and education, alongside addressing past liabilities. Ways to control inflation include using monetary policy, fiscal policy, and price control measures. Let's see monetary policy and fiscal policy in close look. Monetary policy implemented by central banks such as the RBI. Fiscal policy implemented by governments led by entities like the Ministry of Finance. Monetary policy aims to regulate money supply to maintain stability in the economy. Fiscal policy seeks to influence economic activity through taxation, spending, and borrowing to stimulate growth and stability. Expansionary policy aims to stimulate economic growth and increase aggregate demand. Contractionary policy aims to control inflationary pressures and reduce aggregate demand. Expansionary policy involves lowering interest rates, increasing money supply, increasing government spending, and cutting taxes. Contractionary policy involves rising interest rates, decreasing money supply, decreasing government spending, and increasing taxes. Expansionary policy stimulates investment, consumption, and employment. Contractionary policy reduces investment, consumption, and employment. A recession denotes an economic decline with GDP reduction for 2 quarters. A depression signifies a severe and prolonged downturn marked by a widespread unemployment and low confidence, while high inflation indicates a sustained and rapid increase in the general price level. A recession can be triggered by factors such as credit contraction, financial crisis, and external shocks. When lending decreases, financial instability rises, or unexpected events disrupt the economy. It can lead to a downturn in economic activity. A depression often arises from more severe economic turmoil, including financial crisis, systemic failures within the financial system. These deep-rooted issues can create a prolonged period or economic decline characterized by widespread unemployment and economic distress. High inflation can result from factors such as excessive excessive growth in the money supply, which can lead to the imbalance between supply and demand, rising production costs, and shortages in key resources or goods. When these elements combine, they can fuel a rapid increase in prices across the economy, eroding purchasing power and impacting consumer confidence. In a recession, companies respond with reduced investment and layoffs. Market experience decreased demand and declining prices. Equity markets see declining stock prices and increased uncertainty, and foreign investment decreases. During a depression, companies may close. Markets face severe property devaluation. Equity markets see sharp declines in stock values, and foreign investment sharply decreases. High inflation prompts companies to adjust pricing and invest in inflation hedging assets. Markets witness rising prices and increased demand. Equity markets experience increased stock prices and speculative buying, and foreign investment increases. Government spending encompasses various initiatives aimed at fostering economic growth and societal well-being. In short term, such spending injects money into the economy and creates economic opportunities, while in the long term it facilitates the movement of goods and services, thereby driving economic growth and development. Thank you for your time and attention. Consider subscribing to my channel. See you soon.